Good morning, traders and investors. Steve Gans here. It is August 17th, 2025, and I'm going to go through the weekend review here of our markets and give some thoughts and ideas. And later in this video, I'm actually going to share a trade concept. Anytime I share a trade concept, it is for educational purposes and for paper trading. But take a look at what I'm going to share with you a little later in this video. So before we get to that, I want to talk about SPX and the overall S&P 500. So the S&P 500 has in fact broken out last week to all new highs yet again. So it's holding up extremely strong. Something I want you to look at is this blue channel here. I'm going to zoom out. I want you to see that blue channel has been in place for a very long time. We're talking all the way back here to fall of 2022. That channel was largely intact until we had that tariff news, which dipped it out at this point. But we're starting to get back into that channel now. And much like we saw here when we had a little dip out of the channel, when we got back into that channel, just resumed yet again. So are we going to follow that same path here now? Not certain, but the markets do tend to repeat themselves. So I think now that we're getting back into this channel, if we get to where we get in the upper half of this channel, and then maybe we get a little pullback, that would be a line that I'd be watching very closely to re-enter bullish potential trades. And even right here, right now, just a little bit of a blip into that channel. And then we're right back at the edge of the channel. Now, this channel, I should clarify, is my arbitrary channel that I drew. And I'm drawing that off of multiple points. And everyone should learn to draw their own. It's like a Rorschach test, if you will. You look at the picture and you see what you're seeing something. That means that lots of other people are probably seeing those same things. And people react off of that. We are seeing the psychology of the market here in real time when you see a chart pattern in play. So that's what's happening here with the SPX. Of course, the SPY is going to look virtually the same, except the SPY is a little more back into that channel. S&P futures, same basic thing. I didn't bother drawing everything on here. But same basic thing with the S&P future, still in a bullish mode at this stage. And volatility, while we got a very minor little pop in volatility with our down day on Friday, it wasn't much. So there's no fear on the S&P 500 at this stage either. So let's look at the Qs. So with the Qs, very similar, but again, this pattern has been in place for a very long time. Same move, we dipped out of the channel on tariff news. We came back into that channel. We're now about to the top of that channel. And I would expect that if there are pullbacks, they're going to probably come to the lower part of this channel and then resume. This channel also has been in place for quite a long time. It has popped a little to the outside and of course, then down to the downside here. So the reason, of course, that the Qs are holding up so well is because of all the tech companies that are in the Qs making up the NASDAQ and making up that QQQ index. All of the chip companies, computer companies, all of the companies having to do with AI. Then we get down to the volatility on the Qs. Volatility on the Qs extremely low as well. No fear there in the Q volatility. Then we come into the IWM, the Russell Index. So with the Russell Index, basically we haven't gotten back into this channel. The Russell overall has been the weakest of the indexes. The small caps have not performed as well as the large caps. Again, largely because of the top companies in the S&P 500, the tech companies that have been pulling that index higher. It's certainly overweighted in the S&P 500. There's just not that representation in the Russell Index. So as a result, the Russell is showing some strength, but not near the strength the others are. Let's also just take a quick look at the volatility on the Russell. Volatility is low on the Russell as well. So my recommendation for a concept trade or an educational trade is if I look at the Russell as the one index that does have some overhead resistance on it. The other two the SPY and the Qs have broken out to new highs. When an index breaks to new highs, you don't know really where that's going to stop. There's nothing really to act as overhead resistance. In an index like the Russell right now, there is some resistance right here in this, right around the 230 range or so. And there is what I would call support down here around this 215, 216 range. Basically very close to these two green lines that I've had drawn in here for months now. So how might I trade something like that? As an options trader, I would consider maybe an iron condor. And what would that look like? So in this particular case, I'm looking at what I'm calling a skewed iron condor. So what is a skewed iron condor? Before I get to that, let's look at where the break-evens are in here. So the break-evens are at 216 and 234. So if I come back and take a look at my map, that pretty much aligns here. In fact, I can probably pull that upper one in a little bit. I don't need to be all the way out at 234. And then down here, we're about that 215, 216 range. So I'll come up here, I'll pull in this one just a little bit. Now that's going to increase my theta decay, increase my max profit potential. But I also am going to pull in just a little bit here on my protection on that upper side. So why am I doing this? Why am I structuring this trade this way? Let me take it all the way out to expiration just so it's a little cleaner to see what I'm doing here. So I'm selling the 218 put, I'm selling the 232 call, but I don't want that naked exposure. In other words, if I don't buy reinsurance here by buying a long put and a long call, if I take those out of the equation, let me just exclude those for a second. So now all of a sudden, this is an undefined risk trade. In other words, I have a massive amount of risk in the trade, basically unlimited loss potential, and it's going to eat up a lot of buying power in my account. I'm going to have to basically apply a lot of money toward this trade. So to be more efficient, number one, and to be safer, number two, I'm going to go ahead and buy myself reinsurance. This is just like the big insurance companies do when they're insuring for earthquake, fire, etc. They sell insurance policies. They accept a certain amount of that risk, and then they go and buy reinsurance if, in fact, there's a major event that goes beyond what they're willing to cover. And that's the same concept here with options traders. With this trade, I am selling insurance. I'm selling this put to someone, I'm selling this call to someone, but then I'm reinsuring by buying the long put and the long call. That gives me this configuration here where I'm taking in a net credit of $128. That is my maximum potential profit at expiration, anywhere between these strikes. So if the IWM expires up here on September 5th, which is 19 days away, if it expires in this range, I will have my max profit. I can even go as far as these break-evens. That's because of the extra premium I took in. Now, I'm not going to be max profit if I'm here, but I'll still be profitable. So the chance of profit on this trade is a 55% chance of profit as it sets right here, right now. Now, why the broken wing concept? Why did I take on more risk down here than I took on up here? Because my consensus in the overall market right now is a little more bullish than it is bearish. Even with IWM, even though it's not making new highs, it's still acting bullishly. So I want to take on a little less risk to that upside. The other key thing with options, we look at the chance of profit at 55%. That is this exact configuration as it exists here right now. That does not factor in any potential adjustments. The real key in options trading is knowing when and how to potentially adjust this trade. And there's too many variables for me to go into it right here, right now, depending on where the market moves, what does that do to volatility, etc. But the key is that while this chance of profit is a nice number to have, it's not totally meaningful if in fact you're going to be adjusting this trade if you get pressured on one side or the other. So that's just where the skill and art of learning how to adjust and trade options comes into play. I'm going to go ahead and save this trade, and I will save it as weekend review, and this is on August 17th. And I'm going to share this in the link down below so that anyone and everyone can come in, copy that link, and you'll just be able to open this exact same window that you're seeing here from me. It will open up this window, and you do not have to have an account. It will just automatically open up this window. Then you can come in and change this trade however you might like. In other words, you may want to model it in a way where that P&L is tighter. So this is a tighter range here that the market has to stay within, but it has greater profit potential. So these are all the cool things that OptionStrat allows you to do. Now, my chance of profit went down, but again, that's not totally critical given that I know how to adjust a trade in an up move, down move. Doesn't mean my trade will always be a winner, but if the market makes a big shift one direction or another, and I know how to reposition my tent, I know how to flatten my deltas to take advantage of that move, that's the key. So with that, I'm going to wrap things up. If you like this content, please give me a thumbs up, and subscribe, and be sure again to look at the link down below in the description to be able to copy this trade for yourself. We'll see you next weekend. Take care.